Good afternoon, everyone. We're going to make a start. Thank you for joining us today. We hope you're well and safe where you are. We look forward to bringing you this webinar on property tax and the proposed rules for those changes and the Brightline test. I'm going to introduce you to our speaker, Michelle, in just a minute, but first we're going to go over the Zoom controls for those of you that may not be familiar. If you roll your mouse over the screen, you'll see a couple of buttons pop up down the bottom that you can use today. If you've got any questions, you can put them in the chat box or the Q&A box. We'll be answering those either as we go or at the end if it's appropriate. You can click on that leave button anytime you like, but we hope that you'll stay because we've got lots of information for you today. So I'm going to introduce you to Michelle now, our speaker. Michelle has got lots to share and we look forward to hearing from you. So welcome, Michelle.
Thank you so much, Rhonda. I am looking forward to this, sharing this information because it is very topical right now. So my first thought of the day, it's not the strongest of the species that survives, nor the most intelligent, but the one most adaptable to change. So I think in New Zealand, we're all pretty much adaptable to change. Otherwise, we wouldn't be coping under the lockdown. And I think most of us are being very adaptable despite very short notice. Well, all our businesses change a lot as well. And those with rentals, this new legislation that's been proposed about the interest deductibility is a landslide change. And it was unexpected and it has created a massive reaction in the marketplace and a lot of questions, and I'll be going through some of the changes, the most important ones, and hoping that you come away from this webinar with a bit more information, a bit more of a clue. Of course, this advice in a webinar format is general in nature, so for specific advice for your situation, there's no better thing than to ask for help. Okay, so introduction on what we're going to be doing today. Why do you want this? Some mixed use rules, some tax update, changes to the Brightline test, going through the interest deductibility and how that affects somebody with a mortgage, looking at some economic changes since 2020 that have happened. So going back a little bit and then going forward a bit, some next steps and some parting thoughts. I expect this webinar to be 30 to 40 minutes long. I do know it's a little bit technical. If you don't understand, just feel free to raise a question and I'm happy to answer that, either if it's appropriate at the time or later going through. So firstly, getting into the webinar now. So in New Zealand, there's massive interest in the property market, and talking to all my listeners on this webinar, you're here because if you were not interested in property, there's no way you'd be prepared to give up an hour of your time to think about property tax. So you're interested. So I'm going to start at this rule, which has been changed. So the mixed use asset rule applies when you've had an asset that you own privately that you rented out part-time. It's common for batches, but boats and planes and all sorts of other asset applies to the mixed use rules. And they were brought in a few years ago, but they've been ramped up a bit and made a bit tougher since 1st of April this year. So the general rule is that expenditure that relates solely to income earning is fully deductible. That expenditure that relates to private use is non-deductible. General expenditure that's not specifically attributable to earning income, such as rates, insurance, repairs, and interest, when you're looking at a batch, are a proportion between the time that you use the property and the time that you don't, so the non-deductible part. The rules are really strict, extremely specific, and we need a lot of information when we prepare a rental statement for a batch or a holiday home so that we particularly get the rules correct. If you have friends using the holiday home and they pay less than 80% of the market rate, it's counted as a private day. So it's quite specific. So if you're in that situation, you're looking into getting a batch or a holiday home and renting it out partly, please come and seek advice, and so you understand the rules a little bit more than what I've just said now. So I did like this quote though, your house is not an asset, it's a liability. And I just threw this in here because we often think of our homes as our principal asset, and in a retirement sense, that's what we are paying off a mortgage for, to have this principal asset. However, houses require upkeep, they require maintenance, and all of that costs us money. So if you and I have all our wealth in our family home, we're not going to be able to make wealth work for us. So a traditional way to increase our income is living in a moderate house and have more to invest. The exception to this rule may apply if you purchase a larger house now with the intention that it'll be coming under the main home exemption rules under these proposed property market, and then you move to a smaller house after retirement, then you may get a nest egg at retirement, which is capital free. So there's some exemptions coming through in tax planning and retirement planning, which might change what you want to do with your main house. Bottom line is, talk about it, especially with your tax advisor before you come and do anything. What I find though is that my most wealthy clients, they're not ego driven. They don't live in big houses or drive really expensive cars. So having a modest lifestyle is a key thing to think about if you want to get real wealth. So one of the amendments from 1st of April for the mixed home rules is that if you have a regular pattern of buying and selling your main home, or a group of people acting together buy and sell homes, then the main home exclusion that you're relying on for capital gain tax protection doesn't apply. There's no definition in the Act about what's habitual. However, in practice, you'd have to most likely have very good reasons to defend yourself against this charge if you did buy or sell your house more than 3 times in 10 years. So that if they've got good reasons and they're legitimate, you'll probably be fine. But they're really trying to catch those that are doing up a house, moving into a house, doing it up, selling it. I think flipping of the house is the expression for it, and then doing it again and then doing it again. They're going to be caught under these new rules. Not spending too much time on this slide because hopefully all the listeners will understand that ring fencing has applied since the 2019-20 year. So all rental losses are ring fenced. You cannot apply those losses against other income like you used to be able to before 2019. But the residential loss ring fencing doesn't apply to business premises, a person's family home, land already subject to the mixed home rules, or land already identified as taxable on sale. So for property developers and stuff, if they happen to make a loss, they can. I just wanted to show you, because we're doing a lot of this year, what a residential loss ring fencing looks like in a tax return. So this particular owner that we were doing the work for has 2 rentals. The first one, the income for the rental for that year was $12,968. With all the deductions, including interest, it came to $16,000. They had already, from the previous year, had excess deductions over income of $5,000. So we've claimed in this tax return the full amount of the income. So there's no loss that we can claim against other income. We can only claim that deduction, and we've carried forward the extra amount of $8,700 to go against next year's income or profit. And the same applies for this one, which was a new property. They had lower income of $4,700, their deductions of $5,400. We've claimed $4,700 in this tax return, excess carried forward $739. So I just wanted to show you that every property that you have now, it's very specific. It's getting more specific. The tax returns are getting more complicated about how we claim and what we can bring forward and what we can't. So just understand that there's a bit of a process involved in that. Now moving on to the new proposed laws, the Brightline test, as you know, moved from 5 years to 10 years from the 27th of March. There are exceptions to the rules. The exception to the rule includes a newly built house. So if you're building a new house and you are looking at providing extra accommodation to what was there previously, then you fall under the category of a new build. And if you fall under that category, then you're only subject to 5 years Brightline test instead of 10 years. Inherited properties remain exempt from the Brightline test, as the matrimonial separation agreements. There's some fishhooks in there. Main homes are excluded if they meet the definition for a main home exclusion. So there's some special definitions that you have to be aware of to make sure that you meet it. So the 10-year Brightline test will apply only to properties purchased after the 27th of March 2021. Properties purchased after 1st of October 15 were subject to 2-year Brightline, which is already passed. If it was purchased between March 18 and March 21, it's subject to 5-year rule, and after 27th of March 21, it's a 10-year rule. For tax purposes, a property is generally acquired on the day that a binding sale and purchase agreement is entered into. Under the Brightline legislation, the Brightline period commences on the date legal title is acquired. So there's a bit of a slight difference there, which we have to help with the work things out for you. There's exemptions to some things. So when the title's not obtained, but they have still purchased the property, then it's still captured under this Act. So yeah, we will help you if necessary learning. So there are some areas in the Brightline test, which remember is the same as the test that's been there since 2015. It's just the times changed, 2 years, 5 years, 10 years. So it's still the same legislation. The Brightline test may still apply when the property was not purchased for sale. That's pretty obvious. If there's an intention to sell and profit from the very beginning of you doing the enterprise, then that sale is always going to be taxable under the intention test. And that's been the same for over 20 years. So that has not actually changed. The inherited on the property and matrimonial property exemption only applies if the property is transferred under the financial separation agreement or transferred after somebody's died. So that's where I say property is transferred before death or before final separation aren't covered. There's some of the fishhooks. I helped a client pay tax when she purchased a home for her father. She sold it 12 months after that purchase when her father didn't actually move in with a gain of 90 grand. But she had tax to pay of $30,000 that she hadn't expected, because she had expected her father to move into the house she purchased on his behalf. So that was unfortunate, and she wasn't very happy about it. If she'd just come and sought advice at that time, was only subject to the 2-year rule, and selling 12 months later, and she would have had to pay none of that $30,000. It's actually really important to check before you sell something. Or there was a case where there was a bare land with a client living in a caravan. The court said this did not meet the criteria of a main home. And so therefore, even though he was living there and living on the property for more than 50% of the time he owned it, he wasn't able to claim it, and there was tax payable on the sale. Presently, I'm working with a client who did some improvements to the land. She built a livable shed on it. It wasn't CODA compliant, and we're still working out with the IRD how much tax she's going to have to pay on her land when she sold it to purchase another piece of land. So parents helping children to buy homes is a significant issue right now, and there are clients that are really interested in this. They want to be able to help their kids to purchase a house, and they want to be able to do it without striking the Brightline rules and without striking the tax involved if they transfer it later to their children. So in the old days, would have been quite easy for a parent to buy a house for their children and later gift it to them. But now, if a parent buys a house on behalf of somebody else, that, like what I just said with the father, when in the previous situation, you are caught by the Brightline test because it's not your main home, so it's a second home. So Mary Home from question and answer column in the Herald has given some suggestions in the sense that you can make the children interest-free loan. So they own the house and you give them an interest-free loan, or indeed the way that I helped my daughter is that I didn't give her an interest-free loan. I took on a loan on my property and she paid the interest and the principal into my account. But that was seen by the bank as a gift. So you'd only want to do that with children that you knew were going to be paying you back. So there's ways around this, but you do have to structure really carefully and not do things quickly without advice. So one of the things that's changing is there's a lot of letters being issued by the Inland Revenue. Basically, if you sell a house, you're going to get a letter from the marketing department of the IRD. You might be surprised to know they've got a marketing department, but they do. So if you receive one of these letters, don't be alarmed. Just let us know if we're your tax advisor. It doesn't mean you're always liable for capital gains tax, but it would be good to check. In 2013, I purchased a rental property and another one in 2016. I sold both properties with no capital gains tax in 2019. Under these new rules, because I had only kept one for 6 years and another for 3, I would have paid thousands of dollars in tax because of inflation. The properties had gone up in value. Of course, when you're buying another property, it doesn't feel like you've gained money because you're just transferring it to a new asset. So I had no intention to resell when I bought the properties. It would have been a really sad thing for me to pay those thousands of dollars in tax. And this is the way that I think the government is going to catch a lot of taxpayers when there's very valid reasons for sale and of these second rentals and third rentals, people moving, marriages have split, there's different things that have happened, and they will be caught, and there'll be that tax will be added to the person's income and sometimes subject to 39% of tax. So I do believe the effect of the changes that the government have brought in will be massive. They're looking at about $5 billion extra revenue to be gathered every year as a result of these changes. So it's pretty important that everybody knows before they start selling and buying property, they should check what the situation is, particularly selling. So I put a link to the Brightline test for sales of residential property to the IRD site. You're very welcome to check that link out, and understand that the Brightline rules haven't changed. It's just a time period that has changed. I've gone back a slide, which I didn't mean to. Okay, the main home exemption and the 5-year Brightline test. So there's limits, there's exemptions, and that's why we talked when we advertised about this webinar that there's some fish hooks in it. So the property must have been the person's main home for more than 50% of the Brightline period. So if you had moved into it, then been transferred for work, say, to Wellington, and then you started renting out your house, then suddenly the main home exemption doesn't apply. So you've had a change of use. So that can affect things. You must have not been shifted homes more than twice in 2 years. I think I mentioned that before. The main home cannot be used by an associated group of people who have this habitual buying and selling. I mentioned that. If the property is owned by a trust, people can't use the main home exclusion for multiple properties, because often trusts own more than one property, but the settlors can only choose one property to say is their main house. The new build Brightline test only applies to the early owners. That's somebody who's purchased within a year. That's in the proposed legislation at the moment. There's different interest limitation rules on those houses. It applies to all or part of the residential build that has the new build on it, where the land was acquired after the 27th of March. It applies to all residential land with a new build, regardless of what the new build is used for. So if you've got a property and you're considering putting other properties on the back of it, then it applies. The 5-year rule applies because they're new properties, and whether you rent, keep the house vacant, sell it, use it as a holiday home or Airbnb, it is the 5-year Brightline test will apply. It's complicated, right? The second part of this webinar is about the removal of deductions for interest. So interest deductions will not be permitted for residential investment properties purchased after the 27th of March 21. So these rules don't apply if you're a developer and you're purchasing to sell, but if you're purchasing or building to rent, then the interest deduction will not be permitted. So that's important to know. And you have to work out your calculations if you can afford the tax on that after the interest is removed. Currently, rental property owners can claim interest deductions, and it's going to be able to be claimed on a reducing basis over the next 4 years until it's completely phased out by 25-26. As I mentioned, the legislation doesn't affect new builds, property developers, or business loans. You can still claim rates, insurance, repairs, and maintenance on a rental. There's some complicated new definitions of what is a new build. There's complex new builds, standalone buildings, dwellings. There's also definitions about what is a new build, new early owner. So you have to really be careful in what you read. These all changes that are bad, and does this signal that it's no longer good to have a rental property and use it for retirement savings? Well, firstly, I have to mention that these changes are proposed, so the legislation hasn't been passed. However, it's a bit like capital gains tax on properties. It may be changed when the legislation is passed, but we don't actually think it will be. We think there's most of this that has been suggested will happen. Just for clarity's sake, I've tried to put in an example to help you understand the rules, because I think it's in the examples that it's a bit clearer. So Amber acquires title to buy bare residential land on the 1st of May 2021. She starts building and she receives her code of compliance on June 22. She then rents out the new build and sells it on the 1st of October. Is Amber subject to the Brightline test? Boy, I should have done a poll because I'd love to know how you're all thinking. So, Brightline period for new build? No, because it's after the Brightline period is finished, and that goes back to May 21 when she purchased the property, not here June 22 when she got code of compliance. So because it's after the Brightline period, she has been able to sell without any capital gains tax. However, if that is because the Brightline period for a new build is 5 years, not 10 years. Do you understand? So even though she got the registration after 27th of March 21, because the Brightline's only 5 years, not 10 years, that's why she doesn't have to pay capital gains tax in this particular example. So what about a house like I suggested before, where there's a new build that receives code of compliance on the 5th of June? The title was actually registered to James on October, so it's within a year, so he's still seen as an early purchaser. However, he moves down to Wellington, as I mentioned as the example, 3 years later, and so James sells the new build on April 27, is he subject to the Brightline test? Well, because of this change of use, it starts again. And so basically he is sold before the Brightline 5 years, and therefore he is subject to the tax. So this requirement of the main home exclusion applying is, is pretty serious. So the interest rules. So from 1st of October, interest deductions on properties purchased after 27th of March cannot be claimed from rental income. So it's the 1st of October. So if you purchase a property from the 27th of March 21, you could claim the interest up to the 1st of October, but from now on you can't. From this date, no interest can be deducted for new loans, even those new loans taken out to repair like a roof or build a new carport or something. So you're doing something constructive for the rental property, and it's an existing property that you owned a long time ago, but you still now can't claim the interest on that anymore. So with all this legislation, it's still a valid option. So one of the most common options I'm aware of for retirement saving is residential investment. So if you need to hold on a property for 5 or 10 years as a minimum, you'll be seriously looking at wanting to get long-term caring tenants who consider your rental as their long-term home. And if they're happy, you're more likely going to have a property that is being looked after, the rent's paid on time, and over time you will receive capital gain. This quote by Andrew Carnegie is outdated. I think if Andrew Carnegie was alive right now, he might think developing software is the modern way to become a billionaire. However, we don't all have software development skills, so property investing is still a valid long-term plan for building wealth to help you retire. Some of the advantages that I've spoken to about this subject before is that you may get capital gain, very likely if you sell after 10 years. You've got the freedom to mortgage, so you may have 10 grand, but with the mortgaging ability, you can, get leverage on that money, and the capital gain is over the whole lot. You have a variety of different types of rentals available to you: commercial, industrial, residential, and all of those can be in different parts of the country. The income is reasonably passive. There'll be still some involvement by you as a landlord, and there's many ways to structure ownership, but that has to be done carefully. So I'll just mention that too. I am a follower of Tony Alexander. He's one of the economists in New Zealand who is well known for forecasting and explaining results that are happening in the property market. So what's the impact been so far since this was the beginning of 2020 that the slide started? The price growth in property to June 21. So this was reported on less than a month ago. And you can see that, yes, there was some massive, that was June, May, April, March. So you can see in February there was a massive increase just in that month, over 4% price growth in houses, and then it's dropped off since then, but it's still increasing 1% or so a month. So it's not had a definite impact on sales. It's not had a definite impact on days to sell. There's been no increase in properties listed to sell. In fact, the landlords are saying it's actually reduced properties available to sell, but it has definitely had a reduction in the increase of house prices since the tax legislation's come in. I have shared this slide before in my previous webinar, so I'm not going to spend a lot of time on this, but there is an impact in dollars and cents on properties purchased before 27th of March, and you get this grandfathering, is what they call it, of the deductibility of the interest going back down, and the tax effect being dependent on what tax rate you personally are on. So the tax effect on a $700,000 mortgage with 3% interest rate has been worked out, say, at 30% tax rate of about $6,300 after 4 years, or 4,700 after 3 years. So the impact does grow, but it's still quite minor, and an increase in your rent of $100 a week between now and 5 years would basically cover off the value of the extra tax that you're going to be paying, the cash impact of that extra tax. So it's not so bad. And what I do want to mention is the average dwelling in New Zealand rose in value over the past 12 months by approximately 20%, or roughly 100,000. In other words, the past 12 months of capital growth in property has covered investors for the next 20 years of the extra costs from not having interest deductibility. That's pretty massive. So you are going to have a cash impact, but already your property that you've owned has increased in value substantially over the last year. So I help clients by doing wealth planning. So this is an example of a wealth plan before we start. Before we start, actually, we go back and we list all the assets that the property person has. We look at the likely value of the future, and then we look at what things we can do to achieve a different outcome. So we take between 2 and 4 hours to do wealth planning for a couple. That was only one slide of the full wealth plan, but it's a real clarity of making decisions when you have a wealth plan in front of you. It just moves you forward. We go through different options of which one is going to suit you the best, and so you can make some clear action decisions. Sometimes couples come into a wealth plan and they have bit of a different priority about what's important, but through some good discussion of the different options and the advantages and disadvantages together and getting it all out on the table, a family is able to agree on the next steps quite well. I've just found them really fantastic. So one extra thing, and I'm sorry it's taking so long and it's complicated, but almost finished. There is some rollover relief proposed. This is for when you have a property in your own name and you wish to put it into a trust, or you wish to put it into a company, or you've married and you want somebody else to come into the family. So there's some rollover relief. Currently, the law is pretty stifling of changing structures, because at the moment, if you did that, the Brightline test would reapply. So don't change structure without advice. But in the new legislation, the one good news I think on it is there's going to be some relief for people who are wanting to change structures or change ownership, but there's no consideration paid. There's some rules around it. It's the same owners, we're just changing structure, and then we may not trigger the Brightline test, which is pretty exciting for me. So yeah, just a quick summary that, you know, this takes time, going through tax changes and thinking about investments. It can't happen overnight. It does take planning. You need to have some good discussions about your options, ensuring fair division of assets amongst heirs or stakeholders that are invested in properties. Structuring the plan to give children benefit, so that there's some incentive for them to get into their own home and develop their own life goals. Everybody needs to be on the same page. It does take time. So there's no one size fits all. I do suggest you get your own wealth plan, and that you think about it, because I think if you don't think about it, it just won't happen. The result, less stress on the family, some massive high value net value gains. I mean, I'm talking over $1 million difference by doing something versus keeping the money in the bank and just playing safe. We look for resolutions that everyone's happy with, and if we don't get resolution in the first meeting, we'll just set another meeting and redo it. And I've never needed more than 2 meetings. So my suggestion is doing nothing's not an option. You do need to think about your future and make a plan and focus on what you can do within the existing legislation to future-proof your wealth and your family. So we're here for you and we want to help you. So thank you everybody for attending. And now I am just going to invite people to have questions. Thank you.
So we did have a question, Michelle, about interest and whether or not the change to being able to deduct interest applies to new builds as well?
So it does depend upon what you are going to be using that new builds for. So if you're building and you're planning to rent, then my understanding is that there's no deductibility for that interest. If you are planning to sell and you're like a developer and you're going to be taxed on the sale, then you can claim the interest.
Okay, and following on from that, we've got a question about how to specifically work out what the claim will reduce by every 4 years if you're renting.
Thank you. Danny, do you want to answer that one?
Oh, yes. Hi, everyone. About the deduction of the interest. So the IRD just give 5 years period for people to phase out step by step. So if you are our client, I think we can just go through this in details while in the annual accounts review meeting. And if you are not our client, so you can just find out the total amount of your home loan just on the rental property, and then use the percentage to calculate the total interest on the loan, and then just deduct 25% in 2022 financial year is okay. Yeah. So the deduction is like this: is the first year is 75% deductible, and the next year is 50%, and then the year further is 25%. So at the end of 2025, so there will be zero interest deductible.
Yeah.
Yeah.
Okay, and a question about setting up a family trust. If all the properties are transferred into the trust, will they be subject to the 5-year or 10-year Brightline test?
I wouldn't be doing any property transfers to a trust until you talk to an accountant, because at the moment it would be the 10-year rule, because you're transferring it after the 27th of March. So that's disaster for anything. However, if we wait and this new rollover relief, which is in the proposed legislation's passed, then there might be absolutely no Brightline test applying at all. That's what it looks like in the new legislation. So as I said, it's good news for us. It's the best news of the slide, because at the moment we're really limited about what property restructuring we can do with the existing legislation on the Brightline rules. I hope that answers the question, but feel free to contact me afterwards if you're looking for specific advice.
Okay, one more question. If a home is inherited, is tax applied when it's sold?
Danny, do you want to answer that one?
Oh, yeah. Okay. So usually it's not, but sometimes there are some fish hooks and conditions to this. For example, if the house cannot be transferred to you until after the person you are inheriting from has died, for some special tax advice, so you have to contact with us. So because everybody has different situations, so we need to look into the details, and then we can give the final decision and answer.
Yeah. I think that probably sums up my suggestion is property law has always been complicated, but now it's further complicated, and the IRD are not really on your side. So you can ring them up and get advice, but you're almost like ringing up somebody who's got a vested interest in making you pay more tax. So it doesn't make sense to do that. So my suggestion is, before you or anybody you know sells property, especially when it's not just your family home, but it's other things like land or inheritance or marriage problems or whatever, just get some tax advice so that you make sure that you're doing the right thing, and you're not, because you might just have to keep the property for a little bit longer and you'll save thousands and thousands of dollars in tax. Danny and I were working with a client last week where we worked out that he had to keep the property until October 24, didn't he, Danny? And then he could sell and there's no tax compared to being thousands of dollars if he sold now. So it just makes common sense to me to wait if you're in that situation and you have a choice. Yes. So thank you everybody for attending. I hope you found that webinar helpful.
There's just one more question. Is there a list of deductions allowable for rental properties? Yes, there are. You'll be able to find a guide about rental properties on the IRD website. The repairs and maintenance guide is about 58 pages long and has lots of examples and has some extra fishhooks. So pretty easy to claim rates, accountancy, property maintenance fees, bank fees, insurance. But when you get to repairs and you have to work out what's an asset, what's deductible, what's capital and you can't claim it, and then all these interest deductions, it does get a bit complicated. The IRD had this idea of trying to make tax simpler, but unfortunately they haven't. So I think that's it. Thank you very much, everybody, for attending. Thank you, Danny and Rhonda, for your help in presenting the seminar. Goodbye, everybody. Enjoy the rest of your day. Goodbye.